Welcome to the complete beginner's guide on building a consistent monthly income stream through dividend stocks. Imagine a world where your money works for you, providing a steady paycheck without you having to trade your hours for dollars. Historically, dividends have been the backbone of market returns, accounting for nearly 40% of the total gains since 1930. But what exactly is a dividend? Simply put, it's a portion of a company's earnings distributed directly to its shareholders. It is one of the purest forms of passive income available to the everyday investor today. Today, we will break down the exact steps you need to take to build your own monthly dividend machine from scratch. First, let's master the key metrics. The most common is the dividend yield. If a stock pays $1 per year and trades at $20, that's a 5% yield. Higher isn't always better, as we'll see later. Next is the payout ratio. This tells us what percentage of a company's earnings are being paid out to investors. A healthy ratio is typically between 30 and 60%. Anything higher might be unsustainable in the long run. Then we have the dividend aristocrats, elite companies that have increased their payouts for at least 25 consecutive years. These are the titans of industry, offering a level of stability that beginners should prioritize. Crucially, keep an eye on the ex-dividend date. You must own the stock before this cutoff to receive the upcoming payment. To get paid every month, we focus on three main vehicles: REITs, BDCs, and dividend ETFs. Real estate investment trusts, or REITs, are required by law to pay out 90% of their income to shareholders. Companies like Realty Income are famous for paying dividends every single month, like clockwork. Business development companies, or BDCs, act like private equity for smaller businesses and often offer very high yields. Firms like Main Street Capital provide that frequent monthly cash flow many income investors crave. For those who prefer a set-and-forget approach, dividend ETFs offer instant diversification. Funds like the Schwab U.S. Dividend Equity ETF focus on high-quality companies with sustainable growth. By buying one ETF, you are essentially buying a basket of hundreds of different dividend-paying stocks. But you don't need monthly payers to get paid every month. You can use a staggered quarterly strategy. Pick one stock that pays in January, April, July, and October, like JP Morgan Chase. Then add another that pays in February, May, August, and November, such as Procter & Gamble. Finally, add a third that pays in March, June, September, and December, like Microsoft. With just 3 quarterly stocks, you've created a check that arrives in your account every single month. A common beginner strategy is the 50-25-25 mix for balance and growth. Put 50% of your capital into broad dividend ETFs to provide a stable, diversified core. Allocate 25% to monthly paying REITs and BDCs for that higher frequent yield. And the final 25% goes into individual dividend aristocrats for long-term growth and stability. To generate $1,000 a month, you typically need a portfolio of around $300,000. Don't be discouraged. Everyone starts small. The key is to start as early as possible. This brings us to the most powerful tool in your arsenal, the Dividend Reinvestment Plan, or DRIP. A DRIP automatically uses your cash dividends to buy more shares of the same company, commission-free. This creates a compounding loop. More shares lead to larger dividends, which buy even more shares. Imagine starting with $10,000. In year 1, a 3% yield gives you $300. Reinvested, your next dividend is calculated on $10,300. The snowball has started to roll. Over decades, this effect can turn a modest investment into a massive fortune. However, beware of the dividend trap. Many beginners chase the highest yields without looking at the business. If a company's stock price crashes, the yield mathematically spikes. This is often a warning of a coming dividend cut. Watch out for payout ratios over 100%. The company is literally paying out more than it earns. Declining earnings and high debt levels are other major red flags that your income might be at risk. Focus on the health of the underlying business first. A safe 4% yield is better than a risky 10% yield. To begin, open a brokerage account that offers commission-free trades and automatic DRIP settings. Aim for 20 to 60 different stocks across various sectors to minimize your single company risk. Ensure no more than 25% of your portfolio is in a single sector like real estate or tech. Use a dividend tracker or a simple spreadsheet to visualize your growing income and keep yourself motivated. Rebalance your portfolio annually to ensure your top performers haven't made you too heavy in one area. Dividend investing is about more than just your own retirement. It's about building a financial legacy that can support your loved ones for generations to come. The ultimate goal is a portfolio that pays for your lifestyle, giving you the freedom to choose how you spend your time. Dividends also offer a hedge against inflation, as many companies increase their payouts as prices rise. Always choose quality over quantity. A few great companies are worth more than a dozen mediocre ones. Look for companies with economic moats, competitive advantages that protect their profits and their dividends. Be aware of the tax implications. Qualified dividends are often taxed at a lower rate than ordinary income. You might wonder why companies pay dividends at all. It's a way for mature businesses to return excess cash to owners when they have fewer internal growth projects. Consider holding high-yield assets like REITs in tax-advantaged retirement accounts to maximize your returns. Some companies prefer share buybacks, which reduce the total supply of shares. While not a direct check in the mail, this can increase the value of the shares you still hold. Stay disciplined during market downturns. When prices drop, your reinvested dividends buy even more shares. One of the most exciting concepts for long-term investors is yield on cost. This is your dividend divided by the price you originally paid. Think of market crashes as a sale on your favorite income-producing assets. It's an opportunity to build your future. One of the most exciting concepts for long-term investors is yield on cost. This is your dividend divided by the price you originally paid. Never stop learning. The more you understand the businesses you own, the more confident you will become. Unlike bonds, which pay a fixed amount, dividend stocks have the potential for both the payout and the share price to grow over time, protecting your purchasing power. The best time to start was 10 years ago. The second best time is today. Take that first step. During bear markets, while other investors are panicking over price drops, dividend investors stay focused on their cash flow. You are essentially getting paid to wait for the recovery. It's the small, consistent contributions that build the grandest fortunes over the span of decades. Remember to diversify across different sectors. Utilities and healthcare often provide stability, while consumer staples offer reliability in any economy. While we focused on the U.S. market, dividend opportunities exist globally, offering even more ways to diversify. Modern brokerages also allow for fractional shares. This means you can start building a diversified portfolio even if you only have a few dollars to invest. Even tech giants like Apple and Microsoft now pay significant dividends, proving that growth and income can coexist. While building your wealth, reinvestment is key, but once you reach your goal, you can switch to cash payouts to fund your retirement or your passions. The energy sector often provides high yields but requires a careful eye on commodity price fluctuations. Dividend investing is about more than just your own retirement. It's about building a financial legacy that can support your loved ones for generations to come. Consumer staples offer the most defense, as people need these products regardless of the economic climate. To recap, master your metrics, pick your vehicles, and set up your automatic reinvestment plan. Diversify across sectors, avoid the high-yield traps, and keep a long-term perspective at all times. You now have the roadmap to build your own monthly income stream. The power to change your future is in your hands. Don't hesitate to seek out reputable communities and resources as you continue your investing journey. Your journey to financial independence starts with a single share. Make that choice today and stay committed. Thank you for watching this beginner's guide to building monthly income with dividend stocks. If you found this helpful, take the next step and begin your research on a few high-quality dividend companies. Remember, the best investment you can make is in your own education. Good luck on your path to wealth. Small beginnings lead to great things. Keep your eyes on the goal and your hands on the plan. Your future self will thank you for the discipline you show today. Build your legacy, one dividend at a time. This concludes our guide. Start building your monthly income today.